As India's manufacturing sector rapidly expands, Indian economists can be delighted at what the future holds. Standard Chartered, in association with CNBC TV18, launched India on the Move last year, a leadership series aimed at bringing the best minds in the industry to exchange ideas, share experiences, and to gauge the different opportunities for enterprise growth in this dynamic market. We launch another season of India on the Move with a look at all the key insights shared last year. Here, Shireen Bhan discusses global opportunities in trade financing and trade corridors in Africa and Southeast Asia.
What do you believe will be needed to be done at this point in time to make sure that there is significant momentum that's built to keep this relationship going? What are the impediments?
There are sizable impediments. Funding is, for one, difficult, particularly now when commodity prices are low and Africans are not able to afford those kind of things themselves. There was a time when Lagos was connected by a Nigerian Airlines to Mumbai twice a week, but that's no longer true 10 years on. Similarly, there are other possibilities in terms of pharmaceuticals, in terms of healthcare issues. What we have to do is to go closer to the customers, understand them. Africa is evolving. It has among the highest birth rate in the world. Youth bulge has its own aspirations, and those aspirations have to be identified and leveraged.
So building on synergy specifically in the area of services and, of course, leveraging India's strengths when it comes to its soft power and exporting its soft power. But Sundaresan, let me ask you this. I mean, one of the issues that that Mr. Sachdev just mentioned here was the financing aspect of it in, bringing together Africa and India much more and in a much more meaningful way. How do you see that, and what do you believe have been the challenges in being able to achieve that?
Okay. Firstly, trade is a precursor to development. So as banks like us bring our clients on both ends of the Asia-Africa corridor together by industry-specific delegations and by helping finance trade on both ends, we actually lay the path for investments for both parties in each other's markets. And that's the best way for social contribution and human development. Plus, I believe with India's Make in India initiative and then being globally competitive on sectors like pharmaceuticals and automobiles, there is a big market in Africa that India can substitute imports from other geographies like the European Union.
Okay.
So banks like us can help bring together our network, or using our network, we are in 17 countries on Africa with an ability to service 34 countries, bring customers at the Africa end together with service providers and exporters and importers at the India end, and make the connection seamless, easier, transparent.
Now, Lupin has made its entry into Africa via South Africa and via an acquisition as well. Are you looking at more M&A to consolidate your position in Africa?
We have been looking for many more opportunities there, and first, of course, the South African market, because that's relatively easier market.
Easier market to deal with. Yes.
So we are looking for that. Presently, the Africa would be contributing maybe the 5% of our top line. But over a period of time, definitely would look forward to increase the share.
So what kind of expectation do you have? Where do you go from 5% to what is the expectation of the next few years?
I would say we are so focused as of now for the US and Japan.
Right.
So anything up to 10%, I would say we would be happy with that.
CNBC TV18's Lata Venkatesh spoke to leaders of some of India's best companies to explore treasury strategies. Here's a quick look.
Well, as a banker, Anant, we live in very volatile times. So is hedging the biggest challenge for corporate treasury guys?
I think the challenge that CFOs have today probably encompass three parts. First is to know exactly what your risk is. And by the way, it sounds simplistic, but it can be an enormously difficult exercise, especially when you have balance sheets of the size of the gentleman around me, where you have to figure out how much of foreign investments, for instance, you have in other places, which doesn't normally get counted as part of your exposures. A lot of exposures that you think you have might actually not be real exposures. If you have import of commodities, but if you have the ability to pass on the price to your consumers, truly speaking, you don't hold that commodity or FX risk at all. It goes on to somebody else. So knowing the risk itself can be a huge challenge. Second part is managing the risk. I shudder to use the word hedging because it's managing of the risk. Hedging indicates that you reduce the risk and everything is fine. I don't think that state exists. Whatever you do, you're open to risks. So it's managing the risk, knowing full well you'll be evaluated on a hindsight basis.
And not knowing that there will be a Brexit or there will be...
So, you act on the basis of consensus, but you're evaluated on the basis of what people actually can see having happened. And the last bit is, which is a little more intellectual, taking advantage of market dislocations to get a better deal for yourself and your organization. So raising funds cheaply, depending on whether it's bonds, loans, or using the swap market to generate synthetic funds. There are various avenues available that the market offers you at acceptable risk to take advantage of dislocations.
Okay, that sounds like an epic proportion in terms of a job. But okay, taking advantage. Let me come to Shankar on that. Mr. Shankar Raman, you're running the finances of an infrastructure company. Rates are what looks like dirt cheap now compared to what they were even 6 months back or even 4 months back, and definitely what they were probably 3 years back. Does that make task any easier that rates have fallen?
No, I don't think so. Today, the rates, whether they are 25 basis points cheaper or costlier, does not move the needle at all. Okay. Today, we're talking about, from a sectorial point of view, the entire viability of the assets that has been created. The economic viability drives the value inherent and not the interest rates per se. It is not to say interest rates doesn't matter, but they actually do not determine the outcome of the investments that have been made. And secondly, talking about uncertainty and talking about infrastructure sector in particular, the calls that we tend to take in that sector are very long and unusually long, in fact. And we don't have the policy framework that support views over a long period of time. In a way, it's a blessing in disguise because that helps us stay at the short end of the calls. And that actually brings out the basic agility that the team needs to have to manage the risks, which is almost developing on a daily basis.
Let me get to the man who is managing risks of various kinds, Mr. Parthasarathy. First of all, is the strong rupee a problem? Is that one of the bigger challenges for you today?
It is challenges in some industry within the group and as boon in some industries within the group.
You have a mix of both, isn't it?
Mix of both, yeah. So in a sense, it's that whatever comes in, you have the ability to manage the portfolio because of the scale and size that we have of different. Just building on what my colleague just now said, if you look at it, first is knowing your risk. So if you look at what we are exporting, the problem is never to say, is hedging a problem? The problem is to say, do you have a policy for hedging? Okay. What happens is when you change with the change in tides, if the rupee depreciates, then 100% hedging is not helpful, and on the other way it is not. So the first thing is, do you have a policy? The second is, how dynamic is our approach to looking at it? Are you looking at it on a day-to-day basis or now? There are no softwares which are available, which is dynamic hedging, which I suppose manages hedging in a microsecond. But is that what you want to do, or is there a long-term approach?
The whole terrain itself is changing because of new accounting standards, both IFRS and Ind AS. What kind of a challenge does that pose to you?
The challenge or the beauty of this whole IFRS and Ind AS, which is more or less similar, is that at least some of the companies have already, migrated into that, and the financial sector will migrate in the next year. The key point is that what happens in a IFRS situation is that, you have to look at everything not from a form perspective. You have to look at it from a spirit perspective. So you can have an instrument, for example, which is, let us say, a convertible instrument. Let us say, very simple for that matter. Today you are recording that instrument in a certain way, either as a liability or as a, as a equity or whatever instrument, based on a certain form of that instrument. As you go into IFRS or Ind AS, as the case may be, what really happens is the form gets basically broken down into what in spirit it is. Okay. So if it has a component which basically breaks it into, let us say, an equity component and a debt, so today you may be recording in a particular way as a debt, let us say, for that matter, because that suits you from your balance sheet point of view. So when you go into this new accounting standards, you will have to break that instrument in a certain way, and there are manner how you will break it. And you record whatever is a component relating to, say, an equity into equity, and record whatever is relating to a debt into a debt. That is one set of things. So what it also means to a manager, CFOs are not only managing the balance sheets. They are also there in terms of certain business decisions. So a lot of, products which you promote or whatever, decisions which are taken on commercial basis, you will have to look at it from the point of view of its impact on the balance sheets also. While on a form basis, it may look very good, but in substance, when you actually record it in the balance sheet, they will have a different color altogether.
Surbhi Upadhyay discusses with money managers how today's affluent youth are investing for a secure future.
And the big question is, how do we as a nation move from being a nation of savers to a nation of smart investors? Anshu, I'll start with you. That's a tough question. Let's get your opening thoughts.
Well, in our opinion, I think the first step is creating awareness that it is simple, it is long-term wealth creator, making it simple to access, making it simple to execute, creating that knowledge base and awareness. That is number one. Second is very important, is to establish trust. We believe there is a lot of gap in the image of the financial service provider, what is perceived by the end consumer. And we believe that needs to be bridged significantly before this huge adoption happens in the industry on investment solutions or products. And finally, it's about keeping it simple, declutter, demystify, make it very, very simple. And also, like globally that's happened, directed savings into investments, for example, pension funds and other vehicles. If those can be set up and maybe some kind of fiscal policies created around that will direct some flow into simple investment products, that will make a huge difference.
Okay, Nitin, your thoughts on this, and particularly the regulatory environment that we are in, because it's always a question of whose interest. I mean, the advisor has his interest in mind as well, then there is a client and there is a manufacturer. How do you see these trends evolving?
So I think, if I just pick up on what Anshu is saying, and if we actually put these three segments aside, I think the biggest hindrance that we have today to actually encouraging mutual fund use is the fact that we need a common KYC. And therefore today, for a customer to actually want to invest within a mutual fund, there is an additional leg that he needs to do, which actually automatically is a huge hindrance. And this is something that has been raised time and time again by the entire community, be it distributors or be it manufacturers with SEBI, in terms of talking about the fact that we need to allow customers who have a bank account already to be able to invest into mutual funds without any further KYC. I think. But
why is it such a huge hindrance? Because one would imagine with the promise of single-click KYC, things would get more streamlined. Isn't that becoming the case?
So yes, so that is supposed to be the ultimate goal. But today clearly you have something called CKYC, which is what is happening in banks today, and which is of course taking its own form and route over a period of time. And then you have your CVL KRA happening for mutual funds and capital markets, and therefore there is a little bit of a break within this. I think really what Anshu was saying, and if I actually add on to it, if you make the process seamless,
I think that is a huge piece that the regulator can do in terms of really encouraging the use of this medium.
The term SIP, I think, has become far more common. It's in knowledge now across households in the country. But when you're looking at first-time investors and you interact with so many of them across the length and breadth of India, where is the hesitation in making that changeover, moving from that fixed deposit, getting into mutual funds? Has that diminished over the years?
So in 1997, when I started my career in mutual fund, people were asking, what is mutual fund? Today, there is a significant movement. Today, in most parts of India, we are being recognized, we are being asked relevant questions. So we have covered a lot of ground. But a couple of things which we can copy from other financial intermediation sectors. In terms of banking, if we see, there is an implicit faith of government behind every bank. Today, despite banks declaring huge losses, no one runs to withdraw their money because there is implicit backing of government of India. In mutual fund, there is explicit risk factor. Mutual fund investments are subject to market risk. So if we can convert this explicit risk factors in a positive manner, saying that not doing your financial planning is risk to your financial security, I think a lot of connotations will change. The second thing which we have seen is the new pension scheme. It has collected lots of money from government employees because it's compulsory allocation. It gets deducted from your salary every year. In Provident Fund organization, we have seen the same thing. In mutual fund, it is completely voluntary. Now, can I create an allocation backed by some tax advantage in the initial period so that people get experience by default and then it becomes the habit? The third thing which we have seen on the insurance side, their agency network has reached nook and corner. There are probably 2 million plus insurance agents. In mutual funds, there are 80,000 ARN holders, and maybe if you count number of employees in those ARNs, it's about 200,000. You can't expect mutual funds to grow with 200,000 feet on street. I need to make it 20 lakh, just like insurance industry. So how do I do that? I have to copy what insurance industry has done and refine it to make this 20 lakh people. So one, I need to keep customer in mind always, there's no doubt about it. But I need to give him some statutory incentive so that he gets pulled in. I need to have feet on street so that he is hand-holded all the time. And what SEBI has done in terms of regulatory framework, obviously that is creating confidence in mutual fund industry. Put all these things together, I think mutual funds will become part and parcel of every man's life.